Welcome to the Opening Bell Report.
Okay, so picture this for a second. It is a Tuesday morning in February 2026.
Right.
You grab your coffee, you unlock your phone, and you tap on your brokerage app. You know, you're expecting the usual, maybe a little up, maybe a little down.
It's a normal Tuesday.
Exactly. But instead, you see just a sea of red. And right there, kind of anchoring the whole drop, is the one stock you thought was the fortress, you know, the safe haven, Microsoft.
Yeah, it is. It's definitely a stomach drop moment for a lot of people right now.
It really is. I mean, we aren't talking about some volatile crypto coin or a speculative biotech startup here. We are talking about Microsoft, MSFT.
The anchor of the market.
Right. But here we are, looking at a stock that has basically slid 25% from its peak. It's hovering right around that $400 level.
Yeah, it's a massive haircut.
And if you are listening to this and you're holding shares, or maybe you're thinking about buying in, you're probably asking one very loud, very nervous question, which is the party over?
That is exactly the prevailing sentiment out there. I mean, when a company worth $3 trillion suddenly sheds a quarter of its value, it feels less like a routine market correction and more like a systemic failure.
Right, it feels broken.
Exactly. Investors aren't just worried about the price tag anymore. They're worried about the entire story. They are asking if the whole AI narrative has finally hit a brick wall.
Which is so natural. You see that chart going down and you immediately think, uh-oh, did I miss the exit?
Naturally.
But, and this is exactly why I wanted to pull this specific analysis report for our deep dive today, we might be looking at this entirely backwards.
We might be.
The analysis report is titled The Microsoft Disconnect. And frankly, it's provocative. Yeah. While everyone else is, running for the exits, this report is arguing something entirely different. It breaks down why this 20% PE discount is a historic buying opportunity.
It is a classic contrarian take. The core argument in the analysis report is that the market is currently having a panic attack about the completely wrong number.
The wrong number.
Right. They are staring at the expense column, the money going out, and they are completely ignoring a massive flashing signal on the revenue side.
Okay, so that sets our mission for today's deep dive.
Yeah.
I want to know if this is a falling knife that's going to cut us if we try to catch it, or if, like the report says, this is a buying opportunity we're all going to be kicking ourselves about in 2030.
To answer that, we really have to peel back the layers here. We need to dissect why the spending spiked in the first place, look at the actual valuation math, and then
the big reveal, right?
Exactly.
Yeah.
Then uncover a specific metric, something the analysis report calls the golden metric. It basically suggests Microsoft has already sold the future before they've even finished building it.
All right, I love that. Let's start with the pain point then, the panic.
Yeah.
Microsoft shares didn't just, trip. They fell down a flight of stairs. What was the push? Why is Wall Street suddenly treating them like they're toxic?
It comes down to two words that investors absolutely hate to hear during an earnings call.
Sticker shock.
Sticker shock, okay. The catalyst for this huge drop was the Q2 2026 earnings report. Now, the earnings themselves weren't the problem, and we will definitely get to that. The problem was the capital expenditures, the CapEx.
Right, the CapEx. This is the money they spend on the hard infrastructure, right?
Okay.
Like the data centers, the wildly expensive NVIDIA chips, all those liquid cooling systems to keep the servers from melting.
Spot on. It's the physical, heavy-duty hardware required to actually run artificial intelligence. And the bill for Q2 was just astronomical.
Wow, astronomical.
In just 3 months, Microsoft's CapEx spiked 89%, nearly $30 billion.
Okay, hold on. Let me contextualize that for a second for everyone. $30 billion.
In 1 quarter.
In 1 quarter. That's $10 billion a month.
Yeah.
I mean, that is just hard to wrap your head around.
It is a staggering amount of capital. Just to give you a comparison, $30 billion is roughly the entire annual GDP of Iceland.
Wow.
And they spent that in 90 days essentially on computer chips and concrete.
And when a company drops that kind of money, it does something really nasty to the balance sheet in the short term, doesn't it?
It completely crushes your free cash flow.
Right.
Free cash flow is basically the cash you have left over after paying to keep the business running and growing. When you increase your infrastructure spending by nearly 90% overnight, that cash flow number just compresses. It shrinks dramatically.
So all the algorithm traders and the nervous retail investors see cash flow down and spending up, and they just mash the sell button.
Precisely. The narrative on Wall Street shifted literally overnight. It went from Microsoft is the undisputed king of AI to Microsoft is spending like a drunken sailor.
A drunken sailor with $30 billion.
Right. The fear is that they are overbuilding. It's the classic field of dreams risk. If you build it, will they actually come? Or is Microsoft building a $30 billion ghost town of servers that no one is actually going to pay to use?
It really brings back memories of the fiber optic bubble back in the early 2000s.
Oh, absolutely.
Companies spend billions laying all this cable under the ocean that just stayed dark for a decade. Is that the fear here? That this is just money out the door with zero guaranteed return.
That is exactly the fear, margin erosion. Investors are terrified that for every dollar Microsoft spends on AI right now, they're going to get fewer pennies back in profit later because either the competition is too fierce or the actual utility of the AI just isn't there yet.
So that uncertainty is what drove the stock all the way down to this $400 level.
Yes, that panic over the margins.
Okay, so that's the bear case. They are burning cash on a massive, highly speculative gamble. But let's pivot to the disconnect part of this analysis report. Because usually when a blue chip stock drops 25%, it's because the underlying business is fundamentally broken.
Right.
But this analysis argues that the sell-off has actually created a glitch in the matrix when it comes to valuation.
It has. And this is where we need to talk about the PE ratio, the price to earnings ratio. It's the most basic yardstick for figuring out how expensive or cheap a stock is.
Right, basically how many dollars I am paying today for $1 of the company's earnings.
Currently, with the stock beaten down to these recent levels, Microsoft is trading at a trailing PE of roughly 24.3.
24.3. Now, for the listener who doesn't track these multiples every single day, that's actually cheap.
Yeah.
Because 24 times earnings doesn't sound like a bargain bin price compared to, say, a legacy bank or an oil company.
Context is everything with multiples. You can't compare Microsoft to a bank. You have to compare Microsoft to Microsoft.
Okay, fair point.
If you look at the last 12 months before this drop, the average PE was around 34.3.
Okay.
And if you zoom out even further and look at the 10-year historical average, which covers all sorts of different market cycles, it's historically sat at about 31.5.
So at 24.3, we are well below both the recent average and the long-term historical average.
Exactly. We are talking about an over 20% PE discount compared to its recent and historical averages. That is a massive, massive deviation for a mega cap tech stock.
A 20+% discount on a premium asset like this. I mean, usually that implies our market thinks the company is actively dying. You usually only see PE ratios compress like that when a tech darling turns into a dinosaur.
Like IBM in the 2010s.
Exactly. Or like a boring utility company that just pays out dividends and literally never grows.
And that's the exact anomaly the analysis report is highlighting. The market has priced Microsoft as if it has become a slow-growth utility company. They are pricing the stock as if the absolute best days are behind it and the growth engine has completely stalled out.
But has it? I mean, if they're spending $30 billion a quarter, I assume they are trying to grow. But I need you to be the judge here. What do the actual business operations say? Is the company slowing down?
This is where the analysis report gets really fascinating. Because if you ignore the red stock price ticker on your screen and just look at the business itself, the engine under the hood, it is absolutely roaring. Let's look at the actual Q2 numbers.
Hit me with them. Prove to me this isn't a utility company?
Yeah. All right. For the quarter ending December 31st, 2025, total revenue was $81.3 billion. That is up 17% year over year.
17%. Okay, just to play devil's advocate for a second. 17% isn't explosive for, say, a hot new startup. A startup might grow 100%.
That's true, but you have to remember the law of large numbers here. It is incredibly difficult to grow an $80 billion revenue stream by 17%.
Because the base is just so huge.
Right. That 17% is the equivalent of adding an entire Fortune 500 company worth of new revenue in a single year. That is massive, unprecedented scale.
Okay, I can see that. That's fair. So the top line is definitely growing. But what about the bottom line? Because if they're spending so much on this infrastructure, profits should be taking a massive hit, right?
You would naturally think so. But operating income came in at $38.3 billion, which was up 21%.
Wow.
And earnings per share, which is the number that really matters to everyday shareholders, came in at $4.14. That is up 24% year over year.
Wait, walk me through that. Earnings are actually up 24%, but the stock is trading at a 20-something% discount.
Correct.
That feels entirely wrong. Usually if you grow earnings by 24%, Wall Street throws a parade. Here, they threw a fire sale.
That is the core thesis of this analysis report. These are hyper-growth metrics. You have a company nearing a $3 trillion valuation that is still organically growing its top line at 17% and its operating income at 21%. That is exceptionally rare in the history of the stock market.
It's like watching an elephant run as fast as a cheetah. It shouldn't be physically possible.
That's a great way to put it. And the analysis report argues that these sustained growth rates inherently justify a much, much higher premium than 24 times earnings. The fundamental engine isn't stalling at all, it's accelerating.
But the stock price is acting like the engine is broken.
Because everyone is obsessively staring at the repair bill. That $30 billion CapEx figure has completely blinded the market to the growth.
So we've clearly established that the spending scared everyone, but the actual money coming in is growing incredibly fast. But the report says there is one more number, this golden metric that proves the spending isn't just waste. This feels like the aha moment of the whole deep dive.
It absolutely is. This is my favorite part of the analysis report. This is the single number that connects that terrifying $30 billion in spending to the reality of the future. It's called the CRPO.
CRPO. Sounds like a robot from Star Wars. Decode that for us.
It stands for Commercial Remaining Performance Obligation.
Catchy.
I know it sounds highly technical, but it is actually very simple to understand. Think of it as legally committed future revenue.
Okay, so we aren't talking about a sales pipeline or an optimistic internal projection.
No, not at all. These are ironclad contracts that enterprise clients have actually signed. We're talking about the biggest companies in the world. They have legally promised to pay this money to Microsoft in the future for services, mostly centered around cloud computing and AI.
So it's real money.
It's not a forecast. It's a literal backlog of signed checks that just haven't been cashed yet, simply because the service hasn't been fully delivered over the term of the contract.
This is locked-in money.
Essentially, yes. And in Q2, the CRPO number didn't just grow a little bit, it exploded. It surged 110% to $625 billion.
I'm sorry, I need to pause you right there. Did you just say 625 billion?
$625 billion, yes.
That is enormous.
Yeah.
That is well over $500 billion. That is larger than the entire market cap of Tesla. That is larger than the GDP of Sweden, all just sitting there in signed enterprise contracts.
Just sitting there, legally binding, waiting to be officially recognized as revenue over the coming quarters and years. And just to add a little cherry on top of that, the Microsoft Cloud revenue specifically hit $51.5 billion for the quarter, which was a 26% increase on its own.
Unbelievable.
But that $625 billion figure is the ultimate key to understanding the CapEx panic.
Okay, so let's connect these dots for the listener. The market is panicking and selling off because Microsoft spent $30 billion on server infrastructure. But the analysis report is basically saying, hey, look at the backlog.
As the true aha moment, the analysis argues that Wall Street is currently treating the CapEx as a sunk cost or reckless money burn. But when you look at the CRPO, you realize it's actually a necessary investment to fulfill demand that is already legally contracted.
It's like, okay, imagine you run a local delivery service. If you go out and buy 1,000 brand new trucks tomorrow, that looks incredibly expensive. To an outsider, it looks like you're just burning cash for fun.
Right.
But if you tell me you bought those 1,000 trucks because you already have a signed contract to deliver 1 million packages next year, suddenly buying the trucks isn't spending. It's enabling the business.
Yeah. That is the perfect analogy. The report uses the concept of a toll road. Microsoft is essentially building the digital toll roads for the entire next decade of enterprise software. AI, cloud computing, massive data processing. The $30 billion is just the cost of paving the road.
And the $625 billion CRPO.
That proves that the clients have already signed the contracts and paid the tolls to drive on it.
Man, that changes the perspective completely. It's not a risky gamble if the customers have literally already bought the tickets.
Precisely. And that's exactly why the expert view here is that the market's hyper-focus on the expense side of the ledger is completely ignoring the massive guaranteed asset being built on the revenue side.
You're missing the forest for the trees.
Exactly. The real risk isn't that Microsoft is building too much infrastructure. The risk is actually that they can't build the data centers fast enough to satisfy the $500 billion in orders they already have waiting in the queue.
Okay, so the top line growth is there, the future orders are there, massively there. But I do have to play devil's advocate for a second here. Can they actually afford to do this?
It's a fair question.
I mean, $30 billion a quarter is a cash burn rate that would bankrupt almost any other company on earth. Is there a genuine risk that they run out of cash before this massive toll road is actually open for business?
That is a very valid question, and it brings us to the financial health section of the analysis report. We talked earlier about those margin erosion fears, but to really gauge the risk, we need to look at their actual cash generation.
So how much cash are they actually generating right now to fund all this?
Well, in that exact same quarter, the one where everyone is terrified about the $30 billion in spending, Microsoft organically generated $35.7 billion in operating cash flow.
Wait, in one quarter?
In a single quarter.
So they spent $30 billion on CapEx, which freaked everyone out, but they brought in nearly $36 billion in actual cash flow.
Exactly. They are entirely self-funding this historic AI rollout. They do not need to go to the bank for loans. They do not need to issue new stock and dilute current shareholders.
No toxic debt.
Exactly. They don't need to take on what the report calls toxic debt. They're literally paying for the future with the cash generated from the present.
That is a position of financial strength that is just hard to wrap your head around. They are building arguably the biggest infrastructure project in the tech history, And they are basically paying straight cash for it as they go.
And that leads directly to the final verdict of the analysis report. The report frames this current price action, this big drop to $400, this compressed PE of 24.3, not as a structural breakdown of the company, but as a short-term infrastructure digestion period.
Digestion period. I like that phrasing. It's just processing the massive meal it just ate.
Right. The value proposition laid out here is incredibly simple. You currently have the opportunity to buy the undisputed dominant leader in artificial intelligence and enterprise cloud computing.
And you're getting it at a massive discount.
You can buy them at a valuation multiple we haven't seen since before the generative AI boom even started. The report basically argues why this over 20% PE discount is a historic buying opportunity.
That's a really powerful point. We are basically getting 2026 pricing on a company that has already secured the future with a $625 billion backlog, but we are only paying a 2023 multiple for it.
Correct. The analysis concludes that the broader market is just mispricing the stock right now because Wall Street hates the lumpiness of this kind of spending.
They just want smooth, predictable charts.
Exactly. They want smooth, linear lines going up. But real paradigm-shifting business is messy. Microsoft is actively choosing to swallow a massive, ugly cost right now in order to secure a monopoly-like position for the next decade.
So to summarize all of this for our listener today, the market sees a cost problem. They see $30 billion leaving the building, they get nervous and they sell. But this analysis report sees a pre-sold investment opportunity. They see those $625 billion waiting in the wings to come in.
That is the absolute essence of it. It's a fundamental clash of timeframes. The market algorithms are only looking at the next 3 months of expenses, but the report is looking at the next 10 years of guaranteed revenue.
And when you frame it that way, the 25% drop feels a lot less like a crisis and a lot more like a gift.
It certainly looks that way if you trust the underlying fundamentals. The report is emphatic that this PE discount is historic. We just haven't seen an entry point quite like this relative to their actual growth rate in a very, very long time.
So what does this all mean for you listening? We've looked at the panic, the valuation anomaly, the crazy underlying growth numbers, and that absolute monster of a backlog.
It means that sometimes the broader market just reacts to the headline and completely misses the actual story. The flashing red headline was CapEx spikes. But the real story is demand is exploding.
I really love that. Headline versus story.
And if you can manage to separate the two, that is usually where you find the best opportunity.
Absolutely. Well, before we wrap up this deep dive, I want to leave you with something to really think about. We've talked a lot about the math and the specific numbers today, but here's a thought to mull over as you go about your day.
Go for it.
If the market is panicking this much over the sheer cost of building the AI infrastructure, are they completely underestimating the value of the digital monopoly being built on top of it? I mean, if $625 billion is already committed before the paint on the data centers is even dry, what exactly happens when those contracts actually turn into recognized revenue? What does a company like Microsoft look like then?
That is the trillion-dollar question right there. If that massive backlog converts as expected, the earnings power we're seeing right now is just the tip of the iceberg. The expensive build-out today just creates the ultimate cash cow of tomorrow.
Definitely something to chew on. Thanks for joining us for this deep dive into the Microsoft disconnect. Remember, look past the scary headlines, always check the backlog, and we'll catch you on the next one.
Stay curious.
Don't forget to like, share, and subscribe for more.